All right, let's get a check on the global economy now. We have Will Ebong to give us the details. And, Will, I was thinking, while having these conversations, I remember in 2025, I was asking myself, what could be that catalyst to take oil up? Seeing how 2025, went, because oil was range-bound.
Yes.
Most of the, I think it was even a negative performance, for oil. Q1, $75 per barrel. Q2, $67. Q3, $68, Q4 of 2025. I was wondering what that catalyst could be, but it seems it just takes a war.
It's just,
to take oil up.
Unfortunately, it appears to be a war that can take oil prices higher, above benchmarks that governments, especially in sub-Saharan Africa, those oil-producing countries are hoping for to be able to fund their budgets. Nigeria, especially.
Yeah, but we suffer it at the pumps.
Yes, because
sadly.
Inflation, definitely will come and suck that out, and that's what inflation means, higher interest rates, and that means higher borrowing costs. So let's see how that goes for Nigeria, especially now that we should be benefiting and possibly diversifying to be able to ensure that our economy is stronger at this point to be able to fight back, external shocks.
Yeah.
Now let's see, global oil prices, Ladies mentioned it earlier, surged even after International Energy Agency, IEA, approved the release of 400 million barrels of oil, the largest release in history, as markets remain concerned about supply disruptions from the Middle East conflict. And traders are increasingly skeptical that the 400 million barrels from the strategic reserve will be enough to offset global supply risk linked to tensions around the Strait of Hormuz, a key route for global oil shipments. Now, analysts say the reserve release may only provide short-term relief as continued threats to shipping and production in the region keep energy markets volatile and push crude prices higher. And the European national gas prices climbed sharply following the surge in global oil markets as the Middle East conflict disrupts shipping routes and raises concerns over energy supplies. Bench gas futures rose as traders reacted to growing risks to shipments through the key routes such as the Strait of Hormuz, a critical passage for global energy exports. Now, disruptions in the region have already pushed oil prices higher, lifting gas markets across Europe. Analysts say the worsening shipping crisis could keep energy prices elevated as Europe remains heavily reliant on imported liquefied natural gas to meet demand. And next up, global bonds market, we see that wiped out their gains for 2026 as rising oil prices linked to the Middle East conflict fuel fresh concerns about inflation. Investors are selling government bonds worldwide, pushing bond yields higher amid fears that central banks may delay interest rate cuts if energy prices continue to rise. Now, analysts say the surge in oil prices and ongoing geopolitical tensions are raising the risk of persistent inflation, leaving financial markets increasingly volatile and forcing investors to reassess the global interest rate outlook. I think, Glady, you have something to announce to our audience. Yeah, just a quick one. We're going to join in live coverage right now of a pull-out parade ceremony of IGP Kayode, and we'll be joining that coverage on DSTV, but you can follow the money on other platforms. Back to you. Thank you so much, Ladi. Now we see U.S. President Donald Trump says he does not believe Iran has laid naval mines in the Strait of Hormuz, despite reports suggesting the key oil shipping route may be threatened. Speaking amid the escalating conflict, Trump said the United States has already destroyed several Iranian mine-laying vessels and warned Tehran to remove any mines immediately if they exist. The U.S. president also indicated that additional strikes on Iranian targets remain possible as Washington seeks to keep the strategic waterway open for global oil shipments. Now, the administration of Donald Trump has launched new trade investigations that could lead to fresh tariffs on imports from several countries. The probes will examine trade practices by partners including China, India, Brazil, and Vietnam, with U.S. officials assessing whether their policies disadvantage American companies. Authorities say the investigations are being conducted under the International Emergency Economic Powers Act and could result in new tariffs or other trade measures if violations are confirmed. Now, still staying on trade and tariffs, South Korea's parliament has approved a special bill enabling up to $350 billion in investments in the United States as part of a broader trade agreement with the administration of Donald Trump. Now, an investment plan includes about $200 billion for strategic industries such as semiconductors, artificial intelligence, energy, and critical minerals, along with $150 billion for shipbuilding cooperation between the two countries. Officials say the move aims to strengthen supply chains and ease trade tensions after Washington threatened tariffs of up to 25% on South Korean goods if the investment commitments were delayed. And we'll see up next, Morgan Stanley has restricted investor withdrawals from one of its private credit funds after a surge in redemption requests from clients. The bank says investors sought to withdraw nearly 11% of shares in its North Haven private income fund, but the firm only fulfilled about 45.8% of those requests, in line with the fund's rule that caps redemptions at 5% of outstanding shares per quarter. The move comes amid rising pressure in the $2 trillion private credit market, where investors are becoming more cautious about loan portfolios and economic risk, prompting several asset managers to tighten liquidity controls on similar funds. And we see Japan's Honda Motors Co. has warned it may take a charge of up to $15.7 billion as it reassesses its electric vehicle strategy amid slowing global demand for EVs. Now, the automaker said the charge, equivalent to about 2.5 trillion yen, reflects rising costs and weaker demand in key markets. Honda is also cancelling the development and launch of 3 electric models planned for North America as it adjusts its strategy. The company now expects a fiscal year loss of between 270 billion yen and 570 billion yen, reversing earlier profit forecasts as global car makers rethink EV investments and shift focus toward hybrid vehicles. And that's the global news updates. I'm Will Iban.